classify it that way because most of the companies that we're lending to, they don't have, a rating agency coming in and saying, oh, this is a AAA company or a single B or a triple B, which all of the publicly traded, like the FedEx example, that company's got a rating. They have a company that comes in and says, yeah, you guys are AA, based on your business, based on your assets. Well, 200,000 U.S. companies can't afford to go out and get a rating, or they don't want to go out and get a rating. So these are companies that are not rated, and that gets deemed riskier just because they have no rating.
And there's less information available on it, right? So you can't get information on original pancake.
Yeah, they're private.
Right? They're privately held for it. One of the reasons that people want to maintain privacy is that they don't have to deal with public sectors, right? They don't have to deal with somebody coming in, such as a George Soros that's saying, hey, I want to be on the board, or I want this, or this company needs to do that. Being private, they can do kind of whatever they want within the realms of legality, right? So that's one of the reasons for it. So if you think of this account, how many of you either have owned apartment buildings or lived in an apartment building? Okay? At some point in time, right? Well, if you owned the building, what did you get from the building on a monthly basis? Rent, right? If you lived in the building, what did you do? You paid rent, right? Every month, right? Theoretically. Maybe you didn't if you owned it. If you owned it, why did you own it? Did you own it for the value of what it was? Or did you own it for the cash flow that the asset produced? The cash flow. I didn't say, you didn't buy it for, pick a number, $250,000 and say, okay, I hope the 250 is going to go to 4 and then I'll just walk away with 4, right? You said, I got the 250 and I'm going to get $2,000, I'm picking $2,000 a month from of rent coming in for it, and after I net everything out, I'm going to net, let's say, $1,000. I'm just picking numbers for it, right? Does it matter if the value of that building the day after you buy it goes from 250 to 225? Why? You're still getting the income, right? So when you think of this account, this is more of a cash flow account. This is something that's going to produce cash on a monthly basis. Again, you can reinvest it, you can take the cash, that's a discussion to have for it. What's the most important thing about the money? Is it the value? Do I need to have this 20, 30, 50, 100,000, whatever the number is, available to access tomorrow? Then this is not an appropriate vehicle for it. If it's something you say, well, I don't need all of this money available tomorrow, but maybe a portion of it I could afford to set aside for a period of time, 5, 6 years or so for it, to get that high income portion for it, then it could potentially make sense, right? So it's a difference between cash value and the cash flow or the income that you can get for it, right? Think of yourselves as a business. What's the most important thing to the business? The product that they produce or the cash that product produces? Right, cash. The product, great, I made it, but if all it does is sit on a shelf or sit in a parking lot or sit in my warehouse, that does me absolutely no good, right? I produced it, great, but if I can't sell it and get cash off of what's there for it, then I'm out of business at that point in time, right? So it's about, so what do businesses look at? They look at cash flow, right? They don't want, if they sell a product and they get paid in 30 days and that person takes them 90 days to pay them, they may not like them because it's affecting their cash flow, right? The money that's coming in for it. Right? So one of the differences and one reason why companies will use these particular products instead of issuing bonds, because they could theoretically go out and issue bonds at a lower interest rate, right, than what maybe they're paying All Rock at that point, right? The reason is there's a cost to issue bonds. There's a minimum amount that they have to do. There's a minimum time period that they have to have those bonds out there for someone to buy, right? Someone's not going to say, well, I'll give you the bond today and I only want it for a year and then get it back. And conversely, they could go to All Rock and say, hey, we only need this for cash flow because we're going to open up this. We need a short-term loan, so to speak, for 9 months because we have this going on. Where are they going to get that money from? All right. And the reason that Owl Rock is able to get higher rates is because if it's a law of supply and demand. If nobody is supplying opportunity for them to borrow money, we talked about how banks are potentially selling, less and less commercial loans, but I need the money, what happens to my cost? It goes up, right? Law of supply and demand. If there's a big demand, low supply, prices go to an equilibrium, would tend to rise, right? And that's how they're able to get this higher interest rate that they're able to pay out, because A, they could be shorter loans, right? I need the money, I gotta have the money, so I'm willing to pay you, let's say, pick a number, 11%, right, for this 1 year period, because that's what I need to cover, because that's what I need to get this in there for it. After the year, I should be able to repay you, everything should be done, and I can kind of move on from that expense, right? So it doesn't mean, Ted mentioned like FedEx, doesn't mean that they haven't potentially or couldn't potentially loan to FedEx, because FedEx may have a situation where, I don't know, they're buying just a couple of trucks and they need some new ones going out there for it. We only need, a couple $100,000 to do something, and we need it for 6 months, whatever, right? They're gonna pay more for that, but they don't want to go into the market and issue, let's say, $200,000 worth of bonds, right? That are going to be out there for 20 years that they have to potentially pay the cost, underwriting, all of that for it. We go to a company like Owl Rock and say, hey, we just need, a couple $100,000, $1 million, whoever it would be, right? And so that's some of the difference on it. So that's how they're able to get this. From your standpoint for it, it's really saying, kind of a risk factor, liquidity or illiquidity. Right? This is not something for someone who says, I need the money tomorrow. I need it in a year. I need it in a 2-year period, right? This is something, because what you want to think about this money, so to speak, is you're putting it away and you can't touch it. If this is money you're saying, hey, I got to be able to touch this money, it's not the place to be for it, right? Okay. So if you look in the brochure on page 2, there's a really good picture in there for it. Right? If you look kind of about a third from the bottom, where it says kind of traditional asset 60-40 for it, and then to the right of it, it says cash asset allocation models with alternatives, right? Alternatives in that model being that little section there. The reason to have alternatives potentially in your portfolio is because they are not directly correlated to the stock market or the bond market. If interest rates goes up, that doesn't mean that you're not going to still get your 7% annual interest, right? Right? Because the Fed raised rates for it. If the stock market were to go down, that doesn't mean that the company that they've loaned money to is still not going to be making money, right? So it doesn't necessarily directly correlate to what is going on in the market, right? And you want to have those because then that means what's the biggest concern going forward could be your income, right? How many of you Social Security got big raises in Social Security last year? Big raise, right? And what they gave you in Social Security, what they do in Medicare? They remember the big print give it and the small print take it away, right? They moved it from Social Security, your payment went to cost of Medicare cost for it, right? So as inflation, as costs continue to rise, and the income that you're receiving is not necessarily keeping pace with that potential increases, right? There may be assets to potentially look at to reposition to say this could make sense with which to potentially get more income from. And that's a broader conversation and more of a deeper one for your particular situation as to whether it would make sense to potentially have this as part of your kind of portfolio area for it, right? Yes?
So then part 2 of what she thought I was thinking, if you go above the 10,000 minimum, then does that increase how much you receive?
Well, it's still getting that 7% annualized interest, right? It's on a higher value, right? So would you rather have 5% on $1 million or 10% on 100,000? I'll take 5% on $1 million, right? That gives me $50,000 as opposed to 10% on, as opposed to $10,000, right?
Is there a chance you lose your initial $10,000?
Possible. It could.
So
I mean,
high risk?
it could be. I'm not saying, is there a probability? The answer is yes. Is there a possibility? The answer might be maybe.
So there's no guarantee you can get your 10,000 back, even though you don't make any money on it.
Well, it depends. Depends on what you consider making money. Is the dividend or the interest considered making money?
I don't want to lose my initial investment.
Then that may be,
I always have a chance to get that back.
then this may not be the appropriate vehicle for you for it, right? So it all depends, right? I mean, it's, again, think of that apartment building, right? If you have the apartment building, let's say we're going to sell it in 3 years, but the market fell. 2008 happens and market values drop significantly, right? Do you want to sell at that point in time?
No.
Probably not,
Hold on.
right? You say, I'll hold on to it until things start to recover, and then once they recover to whatever level you're comfortable with at that point in time, you say, hey, you know what? It was worth 250, now it's only worth 125, so now I'm going to sell it because it's back at 225. I'm just picking numbers, right? Because you're like, okay, yeah, but what happened during that time period that it went from 250 to 125 back up to 225? You still collected the rent, didn't you? Right? As long as there were, assuming there were people in the apartment building, right? You still collected the rent, right? So is the key behind it again the cash, having that available to say I can walk away with this amount of money for it, right? Or is it the cash flow, the income that we can get from it on a long-term basis? This is not a short-term account.
So like a 403B or 401K or?
That's a particular vehicle. This is be a kind of an investment inside of that for it, right? But it's a longer time period that we're looking at, which may or may not meet what makes sense, right? And that's a whole different conversation.
Is
The-
there, I'm sorry,
That's right, go ahead.
is there anything that can affect your 7%?
If the loans don't get paid, so if all of a sudden everybody out there that they have loans with decides that they're not,
Or one entity or two?
well, one entity, if that one entity doesn't pay, unless it's 90%, so to speak, of the portfolio, it's not going to have a significant impact because we've got 1,000 other people that are part of the paying it, right?
Hopefully.
Well, I mean, if that's what I'm saying. If everybody stops paying, then at that point in time, not only is there not going to be any cash flow coming in, there's not going to be any business there. But at that point, since they're a highly secured creditor, what do they get to do? They get to go to they get to foreclose, so to speak, on all of the businesses, right?
We take over the.
They take over the apartment building, right? And then they can come and then people to run it. So in some instances, there have been similar companies. What they can do is they can actually say, hey, we don't like the management team on this company because we don't think they're headed in the right direction. And because we're a highly secured creditor in that for it, we want somebody better to run it. They could potentially come in and say, you as CEO, you're out. We're going to put somebody else in there that knows, we think, better what to do with it, right? So they don't just necessarily sit passively on the side and say, oh, well, these people, they just know what they're actively reviewing things because situations change, right? And so it's a situation to look at. Is this appropriate for everyone? Probably the answer is no, right? Could this be a portion or part of something that could make sense? The answer could be yes, right? Everybody's situation is different. It's a matter of starting to look at things. If you start to look at where your costs are going, how many of you got property tax bills in the last period of time, right? I'm sure they went down by like 20%, right? Right? They may have gone up. If they went up and your income stayed the same, are you in a better or worse situation than you were last year? Worse, right? Because you have less money available to pay it because you had to use what you were making here, and all of a sudden my bill went up to here. Well, now I have less to be able to pay with, right? If that continues, what happens long term to your income? Your costs go up here, and your income goes down here, and you're like, oh, what happened, right? So if you have assets on the side that may not be working hard for you, there could be options available. This could be an option that could make sense. Yes?
Being that it's a dividend type of return, you have to pay both federal and state taxes.
Correct. Unless it's invested in potentially in the state of Illinois in an IRA account or something like that. Because distributions in Illinois from IRA accounts are tax exempt at this point in time. I always put that qualifier. Right?
Until they find out about it.
Till they find out about it. Right? So there are. I mean, could it be? Most likely, it would be taxable at the federal level. It may or may not, depending on your state situation, be taxable on where the assets are at the state level.
So then you would drip it into an IRA.
No, it could be owned inside, let's say, an IRA account,
Oh.
and then the interest or when you do the distribution from the IRA account in Illinois, at this point in time, it's a non-taxable event.
So I'm saying the interest from this investment tool.
Depends on where it's held at.
Oh, okay.
So if you held it in a non-IRA account, then it's taxable in Illinois because it's a non-IRA account. In Illinois, at this point in time, distributions from an IRA account are not taxable at the state level. So if you hold it inside an IRA account, and let's say you earn $1,000 worth of interest, you say, I'm going to take that $1,000 worth of interest out, you're not going to pay state of Illinois taxes. You could have federal taxes due on it, right? Okay. So it depends. So it's a yes/no answer. If you're in Tennessee where they don't pay taxes on it, then the answer would most likely be no, right? So it could depend on your state or where you're at for it, right? Okay. Any questions on that so far? Okay. So this was a cartoon that was in the paper the other day, and I thought it was pretty interesting. You may not be able to see it, but it's somebody doing their wash, right? And they just took stuff out of the dryer, and they're holding up a little T-shirt, and it says Illinois population, and the T-shirt has shrunk from here to here for it. And then there's a rather large gentleman that is holding the T-shirt, and it says Illinois debts and obligations. Right. So, if you are not aware, over the last decade in Illinois, how many people have left the state on a net basis? 160,000 in the last decade, by U.S. Census Bureau projections. Roughly 160,000 people have left the state of Illinois. All right, that's on top of.
Are they counting the one that coming in also?
That's a net loss. Net loss. Right. Chicago is the only major metropolitan city in the country who has had population losses. Right. So, when population goes down, what also happens? Taxes go up, or the tax revenue potentially could go down because you have less people to collect from, right? Your federal funding goes down because federal funding is based on population of your state. The higher populated states get more, right? So that means less money for roads, education, right? Social programs, whatever they could potentially be from the federal level, because your population base goes down. Also means that you get less votes in Congress because it's based on population. Remember, in 2010 they had to redistrict because Illinois lost two congressional seats. We're probably going to lose at least another 2 or 3 in the next one here for it, which could be a good thing. So when you look at all that, if you have a situation where population is leaving, assume you're still staying, right? And property taxes we just mentioned kind of went up for it. What potentially could happen to other costs? Remember what they did with the gas tax? I want you to think of this, all right? Had the U.S. not continued to expand in the gas and oil and gas industry for it, oil prices probably would be higher than what they are today for it. Do you know that of your gas price you're paying, about $1 a gallon goes to all taxes? Right? In Illinois. I think it's like 97 cents or something like that. Federal, state, local, highway, there's a whole bunch of them that are part of it, right? So think of it, you're paid $2.50 a gallon. Really, if you didn't have to pay all those taxes, you would have had another buck, roughly another buck in your pocket. And could you have done something more with that dollar if you had your pocket? Maybe, right? So as costs continue to go up, the question still becomes where, if you need to keep pace or potentially outpace, right, where are those proceeds going to come from, right? You're probably not going to see your savings account or CDs given where interest rates are at. Mortgage rates are for a 30-year is, you know, what, 3.5 to 4%, somewhere in there for it. Banks aren't going to loan money at 3.5% and pay you 4, right? They're not going to loan 3.5% and pay you 3. Typically, a bank's looking for roughly a 3-point spread, 3 to 4 point spread on the money that they're loaning out. So if they're loaning at 3.5% and they have a bunch of money on the books at 3.5 to 4%, you think that those rates that they're going to pay are going to go up anytime soon? If they have 30-year mortgages that they're only collecting 3.5 to 4% on? All right. So the key starts to look at, if that's not the case, then where and how are you going to keep yourself at pace or ahead of where that cost structure is, right? And there's different ways to potentially do it. But keeping money that's just sitting, so to speak, in cash that's not necessarily doing and helping you kind of keep pace or get ahead may not be the best thing at this point in time, right? So it's a matter of starting to look at what you have. Now you're going to be starting to get all your tax information in here. So about middle of February is when they have to initially have things sent out. Some companies are granted extensions, usually sometimes till the middle of March and that for it, where they don't have to have the 1099s net out. So if you don't have it right away, doesn't mean that it hasn't been sent out yet for it. So you just want to be aware of that. Could be a good time to start to look at those and see what you are earning on potential accounts that may be able to produce better cash flow or that for you, if that's something that makes sense. Okay. Any questions? Wow, I did a good job today, I guess. Well, thank you very much for coming for it, and we will see you next month.